Thank you all for joining us today. I'm Sarah Williamson, the Chief Executive Officer of FCLTGlobal. Our mission is to rebalance capital markets to support a long-term sustainable economy. We're a nonprofit organization supported by leading companies and investors worldwide that develops research and practical tools to drive long-term value creation for savers, companies, and communities. We're very pleased to welcome you today to the third part in our series on investing in the sustainable transition, focused on how capital can change the path to a more sustainable future. We all know that the trajectory of climate change will depend greatly on the actions taken by the business community in the coming years. And a key component of reducing emissions will be the transition of carbon-intensive industries to more sustainable business models. However, foundational transformation can be difficult for leaders faced with short-term pressures, and investors will be critical partners in supporting a sustainable transition. So we know that efficient capital markets reward big business problems, and climate change is clearly one of the biggest problems facing us today. So we believe that CEOs, boards, and investors can decide on their approach to considering climate issues in their portfolios from the top down. In our work, we highlight 4 distinct approaches to considering climate in investing in infrastructure or other assets in a portfolio. The first is the silent approach, where there's no explicit mention of climate in an investment mandate. The second is a principles-based approach, where investors apply their beliefs or principles, such as through divestment or impact investing. The third is an analytical approach, where investors try to integrate future climate scenarios into their investment decision-making. And the fourth is a proactive catalytic approach, where investors try to change not just their own portfolios, but the climate itself, through such as investing in green infrastructure at scale or engaging with companies as they transition to a low carbon business model. So we know that the demand for green investment opportunities is surging with the increased momentum and commitments to net zero objectives across the capital markets, but there are also risks along the way, such as mispricing of green assets or the focus on achieving net zero goals by transferring carbon emitting assets to others, maybe cleaning up one's own balance sheet or portfolio, but putting those assets in the hands of those less concerned about environmental impact. So in today's conversation, we'll explore the ways in which investors can meet the long-term challenge to accommodate both the needs brought on by a burgeoning population that needs infrastructure and the environmental imperatives to transition to a more sustainable infrastructure system. So we're excited to welcome you to this important discussion and look forward to insights from our guests, who I'll now introduce. So Carolyn Hansard is Senior Director and Portfolio Head for the Energy, Natural Resources, and Infrastructure portfolios at the Teachers Retirement System of Texas. She has primary responsibility for the $19 billion portfolio fund and principal investments in both equity and credit mandates in the natural resources and infrastructure sectors. She's also a member of the management committee for the trust. Emmanuel Jacquelot is Executive Vice President and Head of Infrastructure at CDPQ. He's responsible for CDPQ's global infrastructure strategy and investments and oversees the Canadian $30 billion asset portfolio. He sits on CDPQ's infrastructure board of directors and on the investment and risk committees. Sean Klimczak is the global head of infrastructure at Blackstone. He leads the firm's investments in power, transmission, and natural resources, and has been involved in the execution of a wide range of Blackstone's investments, including Tallgrass, Carrick, Cheniere Energy Partners, and American Petroleum Tankers. Scott Lawrence is Managing Director and Head of Infrastructure at CPP Investments. He's responsible for overseeing CPP's significant global infrastructure program. Previously, he was Senior Principal in the Private Investments Department, where he started the Infrastructure Investments Group. He's also launched the Relationship Investments Group within the Public Market Investments Department and was most recently Managing Director, Head of Fundamental Equities. And Kyle Mangini is Global Head of Infrastructure at IFM Investors, where he's responsible for implementing IFM's investment strategy and his ultimate responsibility for the Australian Infrastructure Fund and the Global Infrastructure Fund. Kyle is also a member of the IFM Investors Investment Committee. So we are joined by a wealth of knowledge today in this topic. And so thank you all very much for being here. So Sean, I'm going to start with a question to you, if I could, about the tension that can exist between achieving individual net zero goals, achieving one's own goals in one's own portfolio, and decarbonization itself. So how do you think about the removal of sort of, dirty assets, if you will, from a portfolio? And how do we really incentivize investments in the necessary assets, such as brown power sources, that we need to actually get this, keep this world running?
Great. Well, good to be with you and all of our panelists here today. I think it's obviously a very topical conversation to have. I'd say, firstly, from a net zero perspective, we at Blackstone are highly focused on investing behind industries such as renewables, where we've invested $13 billion of capital over the past decade, $2 billion even just last year, and investing behind electric vehicles and many other efforts around decarbonization. But what I would say is to your question, we've got to, I think, as investors, be practical about where we are in the energy transition. 60+% of our power generation today is fossil generated. And number two, 99+% of our vehicles today are still internal combustion engine. And so I think it is incumbent upon all of us as investors, I think, to try to find ways with those investments that still have significant carbon exposure, to find ways to reduce emissions. And I'd say, as a firm, we've taken a very proactive approach from a top-down perspective across all of our managed portfolio companies. We've made a commitment to reduce emissions by 15+%. And whether it's just take within our infrastructure portfolio, whether it's replacing cranes and cargo handling equipment that used to be internal combustion engine operated, making that electric, investing behind electric vehicle charging stations at our rest stop businesses, or swapping out power generation for our pipelines from fossil fired to renewables. We've been highly focused there. And I would just say that I think it is incumbent upon all of us as investors to obviously drive returns for our investors. But I think it's quite clear that these investments make economic sense. And I think a lot of the various different programs that exist today help incentivize that. And the last thing I would just say is in terms of incentives to try to transition our economy, 70+% of our power generation in the United States is generated via the investor-owned utilities. And I think taking a look at the utility model is a really good example of a way that we can think about transitioning our economy. And within the regulated utility model, where utilities can swap out depreciated assets like coal plants that have high operating costs, swap out those assets into new assets in rate base that are low operating costs, new renewable assets. I think that's exhibit A for all of us, about different models that can exist within a regulated construct as to how we as investors can continue to invest behind decarbonization more broadly.
Great, thank you. And speaking of regulation and the role that regulatory targets can play, Emmanuel, I know that in many countries there are increasing both regulatory targets and also, of course, net zero targets. How do you think about them when you're thinking about portfolio risk? How do you bring those targets into play? And what steps do you think that asset owners and investors need to take to manage the risk in your portfolio in light of some of those changing commitments and requirements? How does that flow through the portfolio?
Hi, everyone. Hello, Sarah. I think it's at the heart of what we need to be doing with general portfolio, but in particular with infrastructure. And perhaps on the first part of your question on the what to do, perhaps being a little bit blunt, I've seen the story play out, and all our distinguished members around the table here are well advanced there. So, but I think the first step is always, the semi-denial. The net zero tide will turn. I'll do a little bit of window dressing. In the meantime, I do a nice sustainability report with great pictures, perhaps putting a few solar panels on an administrative building of a coal plant. and be done with the job. I think that holds for a short period of time. Then you move to steps 2, and we're all big asset managers, and when you're in the listed market, you typically, what you do when you don't like something or a sector, you sell. And I don't think that works really well in the interest portfolio. First of all, the liquidity is not necessarily there. Plus, playing hot potatoes and just sell off your CO2 emitting asset and try to buy greener one in renewable and transmission. Yeah, that's fine. But again, you're probably not great at the market timing there. And I think the third step, and I think Sean alluded to that, and I think that's what you call the catalytic approach in your intro, Sarah. And that's the one I'm advocating, as you can imagine, is coming back to the definition I like of infrastructure, which is essential community essential assets. We need to reshape these essential assets because they're not going to go away. But you need to reshape them for the net zero world of tomorrow. And we are convinced that this is where we're heading for. Fortunately, we have a bit of time. I mean, we are long term, and this is the purpose of this forum. We have time to reshape these. I can give you a couple more examples. Sean gave a few, but we have an investment in utility in Indiana, and we've decommissioned coal plants in 2016, and we've halved the CO2 emission. We started replacing it with gas. Now we're replacing it with solar and wind. And gradually there's an end date where the last coal plant is going to be burning coal, and that's we could have sold it off, and perhaps the new owner would not have reshaped the portfolio, but it created a huge fervor in the team, and for us it's a great achievement having decommissioned those coal plants. The second example is we are big players. We fund VC funds. We look at different sectors. So early on in our school bus company called Student Transportation, we looked at alternative fuels, and we pushed our management team to look at it because we feel where the wind is blowing, and we now operate 2,000 alternative fuel vehicles across 6 states. So it's a start. I think it's great. Quickly on the second part of your question, the mindset shift required. It wasn't an easy journey in CDPQ. It took like top level push to make it happen. Very comfortable investing in our usual oil and gas sectors, etc., across the portfolio. But we had to change the people mindset. So the way it was designed is company full of engineers, accountants, actuaries, MBAs, and the like. So you had to make it very numerical, auditable. It's easy to greenwash the narratives, as I mentioned earlier, but hard data, facts. So we defined a KPI, ton of CO2 per $1 million of invested capital, and we committed to reduce it by 25%. So a bit more than Sean by 2025. Here you go, challenge. And there's an independent team in charge of doing the computation. That's important. Yes. And we included that in everybody bonuses. So not achieving the target, everybody in the company takes a hit on its bonus. And as you can imagine, infra is a big contributor to the carbon emission. So we are being scrutinized by our colleagues, and it's a very powerful motivator, peer pressure. So that's how we made the mind shift.
That's great. Yes, peer pressure and hitting everybody's bonuses goes a long way to focusing the mind. Carolyn, let me turn to you. Emmanuel talked a lot about decommissioning assets, getting rid of some of the bad ones. The flip side of that is innovation and how you think about how do we go the other way? How do we think about innovating to create long-term value in infrastructure? Can you talk a little bit about how you think of innovation and adaptation as you think about the investing that you're doing?
Sure. Thanks, Sarah. So let me first give a little background. The portfolio that I manage at TRS includes both energy, which includes all types of energy throughout the full value chain, as well as infrastructure. And we use a risk framework when we make investments. So we think about innovation and adaptation 2 ways. On the innovation side, we think about we definitely need innovation, and we've been investing in renewables for over a decade. Now we see a lot of energy funds looking at energy transition as a theme. And most of the energy funds we invest in are private equity style funds. So they're way ahead of the development curve and more almost VC type investing. In the infrastructure portfolio, that's a little too high risk for us. So we think about infrastructure having some certainty in cash flows, and we would invest a little later in the adaptation of the life cycle. So that's the first way we think about it. What's the risk of the innovation? Where in the development of the life cycle is it? And where is it appropriate for the various portfolios? The other way we think about innovation is a risk of obsolescence and disruption. So every time we look at an investment, one of the questions we ask is, what are potential disruptions to this investment? And that could be, it makes the asset either obsolete, in which case when you underwrite it, you may have to assume you got to get your cash flows back very quickly. You're the last owner of the asset, and are you good with that? And the second is, how quickly can you adapt whatever the asset is to deliver value for the portfolio? So it is a big topic of ours in all the investments we make. Definitely supportive, but again, they have different connotations depending on the portfolio. The last thing I would say, there was a question around risks that are presented by climate change in the physical assets. A big thing we're also focused, a lot of discussions have been around renewable and power assets, but climate change is also about redistribution of water. So if you think about, ultimately, that's what's happening with extreme weather events. It's the water is getting redistributed around the planet. And that's an area that we're focusing on a lot, is water. And as Sean said, some more utility type assets, and what are the implications to those types of infrastructure assets.
I want to come back to that in the extreme weather, which unfortunately you learned a lot about in Texas this few months ago here. So, but Scott, let me turn to you. Carolyn's mentioned this idea of obsolescence and are you the last owner of an asset? Can you, how do you, look forward and figure, you obviously have to think about what you're going to get paid on exit when you go in. So given the changing nature of infrastructure needs and innovation, how do you think about factoring that into your rate of return, and how do you place a value on long-term contract life when the pace of change is so rapid?
Yeah, thanks for that, Sarah. And thanks for inviting me to participate here. It's a lot of fun to sort of see, all of my global colleagues and have a debate about something that's really timely. It is a difficult question, and let's call a spade a spade. As we think about energy transition, natural gas occupies a really interesting part of the spectrum, where a lot of people are talking about it as a transition fuel, which implies that there's a cliff. And as we know from other technologies in the data world, things that were predicted to have a long tail can all of a sudden fall off a cliff. And so from our standpoint, the way we look at it is I guess, in two different ways. One is we're very cautious against betting against human ingenuity. So to the extent that there are a bunch of owners of assets that, employ natural gas, and certainly there's a lot of end users that depend on it, there's going to be a ton of investment in trying to make natural gas usage a lot more efficient, a lot less carbon intensive. And that goes everywhere from, increasing efficiency to carbon capture and storage. And so that may, lengthen the life of natural gas. Offsetting that, there's a whole lot of ingenuity and investment happening to absolutely eradicate it and get rid of it sooner, through the application of hydrogen and lowering the cost curves on just about everything that's in the renewable spectrum. And so the way CPP Investments approaches it is, one, a portfolio theory and approach where we have the benefit of being able to invest in early technologies and different sleeves that we've got, but also because of the nature of our long dated liabilities, which go out 75 years, to the extent that all of a sudden an asset may no longer be saleable in a conventional Wall Street fashion, but is still throwing off cash flow in that long tail, we've got the ability to hold and generate yield for our stakeholders through just holding it forever, so to speak. And so while at the same time applying all of our capital and ingenuity to try and reduce the carbon intensity and make it better for the planet.
Well, that time frame is something that really does play to your advantage in this world. I'm sure others would like to have that time. Some of you do. But Kyle, turning to you, we know that various governments around the world are taking different approaches to climate change, and you obviously have to invest across those different government policies. So how do you think about the role of government policy in sustainable infrastructure transitions? How important is it to have a public-private partnership? Is that a solution or a complication? And what do you think from a policy point of view is really required to promote effective investing here?
Thanks, Sarah. Look, I think it can be extremely important if it's done thoughtfully. But first, let me say, one of the most important aspects around change is getting organizations like the one on the call today together and aligned and aiming towards the same end line, because we'll often invest together. And if we have the same perspective and we're sitting around the boardroom table, it's a lot easier to affect that change. So I think as big global investors, seeing eye to eye on these things is going to make an enormous difference. I think from a government perspective, there's a couple of different variables. The first, and this is a sort of a personal issue with me, is just trying to get ahead of the amount of waste that still exists within the system. It is absolutely massive. It's low hanging fruit. It's ESG that more than pays for itself immediately. And there's been some advances, things like LED lighting, for example, are, it's very, very simple, but they have a very, very short payback time, insulation, just kind of general waste, and getting everyone's mindset into that sort of easy win of taking a lot of the carbon out of the broader system. And the only way you're going to really change those behaviors is through some type of broad regulation. It's going to need to be relatively local and relatively micro. But to me, that's just an easy change without really affecting people's lifestyle. But I think more importantly, everyone on this call probably agrees that markets work, and markets work pretty well. And right now we're in a setting where renewables are crossing over where conventional generation cost lines have historically been. So I used to say that combined cycle gas was the best option, and then you'd look at wind and you look at solar. Now you can do solar at less than what it costs to install combined cycle gas generation. So the markets will drive those outcomes, and the markets will work. What I think is really needed by government entities, and this is global, is planning. It's thinking about where do those assets go from a system perspective of seeing past just very simple markets where everyone gets paid the same regardless of where they are or how they generate, to putting in some market mechanisms to ensure that we're thinking not about next year, but about the next 5 years, 10 years, and 20 years. So we have a system that actually integrates and works very well. And that's pretty much it. I don't think there's a lot more that needs to be done around driving the market to deliver opportunity. But the final thing I'll say about regulation is, at the end of the day, it does help. So as we're sitting around as investors, we have to comply with the law. We have to comply with regulation. And sometimes having that in place, having a maximum allowed emissions or price, that helps force the hand of decision makers.
So Emmanuel, I'm going to come back to you, and then I'm going to, of course, you all can ask each other questions too. I don't have to be the only one, but I'm interested in, you had those stages, the sort of denial, and then maybe the window dressing, and so on. And Kyle was talking about regulation. Do you see that as just improving speeding up that denial, or do you think that we really kind of have to wait for the market to make those signals visible? Because I think, Scott, you mentioned 75 years. I'm not sure we do have time, but I'm not sure we have 75 years. So how do you think about speed? Do we need the policy to speed us up through your stages? How do you think about that?
I think it's the heart of the problem, Sarah. And I mean, when we went with our carbon reduction target, we said we're going to do that, and it's going to be profitable. I think that's what everybody on the panel has said. And this extra bit of regulation make it obviously necessary and profitable to go for those low carbon solutions. I'd rather, let the market play and get incentivized to do the right thing, that helps, than get in a few years' time, the regulation, impacting me negatively. That's also a powerful motivator. So, I kind of like what happened with the renewables that came with crazy feed-in tariff, that sort of kick-started the kind of a revolution we're seeing now, and we are convinced it's gonna keep on. One thing we're working on, and we're trying to be a little bit ahead or not behind the curve on this one. Hydrogen is another example. We're seeing a lot of governments trying to lay out some incentives, different mechanisms, different solutions, and I think that's going to be a great help on some of our existing gas networks, distribution assets, transmission assets. So that's something to look at. It can help. Rather than wait for the negative, let's pick up the positive incentives that we can see and get.
John, let me come back to you. You've obviously on this panel got a lot of large, sophisticated investors who sort of can weigh these things out. From your perspective, though, do you see kind of money just flowing into green assets in a way that's perhaps not as analytical, could I say, as the people on this call? How do you think about the wave of money that is coming into green, anything that sort of is labeled green?
Yeah, well, I think it's pretty clear for all of us who are investing in the sector. We can all say that we wish we would have invested more money 5 years ago relative to today. Pricing continues to get tighter and tighter, and I think the green premium is real. And I think as you take a look at the assumptions and even the contracts that underpin these projects today, I think things continue to get more precisely or finely tuned and priced. And so whereas you might have had to Manuel's point, you might have had a long feed-in tariff, then you had a off-taker that started at a 20-year contract, then 15 became acceptable, then 12, then 10, and we're seeing I'd say an evolution in that market. And then the portion of your initial capital base that you used to be able to recover through the contracted life, that has continued to tighten. And then lastly, everyone's assumption about what is going to happen to merchant power prices. I think people have just continued to get more and more aggressive, whereas now market dogma is that power prices will go up at 2% a year for the next 20 years, despite the fact that we're adding a lot of zero marginal cost power to the curve. So I would just simply say, I think the green premium is real today. And I do think that we've all got to be more and more creative. I think investing models have had to evolve, whereas many investors would have loved to have purchased just simply existing assets in the past. I think we've seen the migration of our, those around this Zoom screen. We've seen many of us migrate toward development, greenfield development of assets, and to just continue to evolve our models. Or even as Emmanuel is saying, if we're getting priced out of one market, maybe we're moving into things like offshore wind, or we're moving into hydrogen and trying to get earlier and earlier in the cycle. But I think the market's working. Back to your broader point, I think the regulatory mechanisms that were put in place have allowed costs to come down, and I think ultimately the market will find its equilibrium, and people will, I think at some point in time, the market will equilibrate, and we'll have a market that continues to support what we're all targeting for, which is a net zero economy.
John, I'd add that I think your point is spot on, and in a lot of ways, what you're describing is a bubble, right? It's a green bubble, but it's a bubble with the amount of investment, with the risk allocation continues to shift towards equity, and as potentially money that goes into the space is maybe not quite as long term or sophisticated in other money. Anytime a bubble bursts, it has a taint, and hopefully we look in a situation where some really positive activities now lead to a bubble bursting and tainting the sector that, rather than speeding things up, really slows it down over the long term.
Yeah, I was just going to jump in and say that similar point, Kyle, because as I mentioned, we've been investing in renewables. We'll stick with renewables for a second, for over a decade. The only investment we made, which didn't go well, was supported in Italy by subsidies, and they changed the subsidies. So all of a sudden we have assets that are not worth much. But what's happened now, going to Sean's comment, we're looking at renewable assets that have the same risk profile that we invested in a decade ago when we were penciling in sort of 18 to 20% returns, and they're being underwritten somewhere between 8 and 10. Same merchant risk profile. And so, for us, it's been extremely difficult to find investments that meet both our risk and our return in the green space. We did really well on the stuff we did early on, but now it's a lot more risk at lower returns. So, and I agree with you, Kyle. Is that the canary in the coal mine, no pun intended, for a bubble?
So it sounds like there's a risk of a bubble. Is there also a risk of sort of this is bifurcation, which is some people care about green and some people don't? I mean, what's happening, maybe Scott, back to you, with the people who don't care about the green label? What is the other side of the equation, if you will?
Yeah, which I have to say we're seeing more predominantly in private capital spheres. And I almost want to label it private, because there's obviously, private funds that raise money from institutions that have a, higher level of accountability and are expressing the desires of those capital providers, many of whom are public institutions. So we're really talking about ultra high net worth and others that quite frankly are a little less opaque in terms of where those dollars are going. And as we see the oil price go from 40 to 50 to 60 to some forecasts I've seen at 80 to 85, I imagine that there are people who are investing in upstream oil and gas assets who are going to play it for the yield over the very long term and pray that, there is a long tail there, but recognize they're up against a wall of capital that is investing in ingenuity. So, they're making a very specific bet. So I think, what's happening is there's a lot more, I'd say, risk in the system. But that risk, interestingly, isn't just risk to the downside, it's risk to the upside as well. So depending on where you make your bets, you may have the luxury of making a lot of money if you're early. And like Sean said, can find different pockets of disequilibrium. There's still opportunities. And for us, some of those things are, or maybe batteries, charging stations. I'll tell you, software to help manage the grids, because the more renewables factor in, and then you've got distributed energy sources, we're raising the bar in terms of the sophistication that all of us need to bring to bear to manage, citywide and statewide utilities.
Well, we've just had this problem, as you know, with the Colonial Pipeline in the US, which speaking of software to manage things. So the risks are, those are very clear risks. Emmanuel, you started to say something.
No, I just want to build up on Scott's point, which is, there's people who are comfortable going for the non-carbon free asset today, and they're probably making a decent return. My sort of mid to long-term view is ultimately, you have to follow the money path, right? And it ends up in a lot of people around this table, ultimately, are other sophisticated investors. So you may have raised a fund a few years ago without a lot of vigilance on what you could do with it in terms of the sectors, etc. But I think this pool of capital is gonna grow smaller and smaller. We've seen even the big investor like Berkshire Hathaway, which he still got away with his resolution, but still ultimately he's gonna have to come up with a bit of the sustainability report I was mentioning, which is step one in my personal view. But this pool of capital that is indifferent to the global carbon situation, I think is going to grow smaller and smaller. And those pool of capitals are going to be making less and less money ultimately. So that's my forensic view here.
I hope you're right, but I'm not sure that as the pool of capital, we can move the dial by ourselves. And it gets back to that waste variable. And when you look at the number of individuals, of families who voluntarily pay for green power when they have an option on their utility bill, it's not that high. It's people will go for the lowest cost option. And so I think there's a lot more that needs to be done on the demand side. And whether that's through education or through different market mechanisms, it's a two-sided equation. And I think we need to do everything we can on our side, but also reflecting the fact that the other side really needs some work. And let me give you guys a sort of semi-personal anecdote. I walked around our floor in the office a couple weeks ago, and I worked out that on one floor we had 5 refrigerators that were running 5. Now we don't anymore because I walked around and checked. But that's the kind of thing that needs to stop and that we need to get ahead of. And I think that the only way that really moves forward is some kind of pricing signal around demand if we're going to solve the problem from both sides.
So Carolyn, you mentioned water, and that's another area where the pricing signal is often poor. And there's a lot of waste, as Kyle is talking about. Can you tell us a little bit more about your thinking there? And is pricing coming into water in a more sensible way over time? How do you see that evolving?
Yeah, that's a really good question. We spent a lot of time on this several years ago because at the time Texas was in a huge drought. And so there was a question of, how can we as institutional help change that? The biggest challenge with water is it is a very emotional asset. So generally people think it's free. It's in the sky, it's in the river, it's a free asset. And then something like Flint, Michigan happens and you realize maybe not so much. So the key around water, I think, is going to be to get the mindset out of that thinking that it's a free asset and that it's more of a limited asset and a precious asset. And then the second is getting some coordination around how do you invest in it, because you don't want to be the investor that's causing everybody's water bills to triple, right? That's not going to be a good look for TRS, and that's certainly not something we would do. So it's tricky, but it's definitely an area that needs investment. I think a lot of folks are focusing on the waste part of water, as Kyle mentioned, so the waste systems, but whoever figures out how to do that for institutional investors will be great, because I think it's long overdue and something we're super focused on.
Well, you said, that wouldn't be a good look. The whole reputation issue around this area is so tricky. And I think we, have alluded to this a couple of times. Maybe Sean, I'll come to you on this one, but are there things that investors can do to offset some of those risks? Because sometimes we see people wanting to take on assets that perhaps to decommission them or transition them in some way, but they don't want the reputational risk of taking them on in the first place, because there may be somebody standing outside their office with a sign. So how do you think about that? And maybe I'll ask some others as well to jump in on that problem.
Well, I think you're putting your finger on the pulse of it. I think there's an extensive amount of work that goes into to evaluating any investment as to whether or not you've got the intestinal fortitude to go take on the challenge. And so, as I think about it, I'll pick again maybe on the utility sector, and maybe to Emmanuel's earlier point. Do you consider investing in a utility that has coal exposure? It's still a substantial portion of the power base, circa 25% of power generation in North America. And would you say no to investing in a utility that has coal? Or to Carolyn's point, would you take on a water utility that's got some real work ahead of it. And so I think there are extensive discussions at our investment committees on all things ESG. And we think that's absolutely central to an investment decision. And I think many of our organizations, back to Manuel's like 3 stages of evolution, a decade ago, some of those questions may not have been asked. Today, they are. And I think one of the real questions for us is how can we be a catalyst for change? And do we have the ability to be somebody who accelerates, say in Indiana, the migration toward renewables, and not just simply because a static situation looks one way today. The real challenge, I think, for all of us as investors is what can it become? And I think we're well past the phase in infrastructure investing today where we're just buyers of static assets. We have to be people who intervene operationally and strategically. And I think the questions for us on each of these types of investments are we up to the challenge of trying to reimagine what this company can look like and ultimately be the change agent that is necessary? And so back to the earlier question, do we just simply go into the easy situations where there's no work to be done? I think as a general rule, that hasn't necessarily been our approach at Blackstone. And I think but we do we think about the sort of the height of the mountain before we go march up it? Absolutely.
I think there's a combination of intestinal fortitude and trust a little bit from your constituents. And Carolyn, I don't know if you were going to add on to that, but
yeah. Sarah, going back to the headline risk, that's big. I mean, I think probably for all of us on this call, and we've actually turned down really good investments because we just like the headline risk is so great. Someone once said to me, as infrastructure investors, we only get notice when things go wrong. So because of the headline risk, and because by the nature of infrastructure, it's something that's necessary for society to function. So if it goes sideways, that's a huge consideration for us, and it ties into the whole notion of innovation. And secondly, to Sean's point a little bit, is you got to make sure that the team you're investing in is really knowledgeable. So, because there are a lot of folks out there and, operating the assets properly or making sure they're paying attention to all of the regulatory and environmental issues, because that's almost as important as the asset itself. If you don't have a good team operating it, they can, run good quality assets into the ground and create all sorts of issues.
So it's not just looking at the height of the mountain, it's also thinking about the team you've got to climb that. That's right. So in terms of transitioning assets, one of the things that we have been really interested in is how do people, rather than being, nervous about taking those on, sort of get credit for that. And Emmanuel, you talked a little bit about your own team getting credit for transitioning an asset. And Scott, I know you've got a long time period, but are there ways that we could, as a community, as a group of investors and companies, be pushing to get people credit, if you will, brownie points for decarbonizing assets or decommissioning or doing the right thing? Ideas on how to do that rather than just having it be a negative headline risk? Manuel?
I probably framed it. We actually get an extra tiny layer of bonus if we succeed. So it's turned a positive way, to your point, Sarah. So that's the way it's structured. It's not punitive. It's accretive. But it does turn out into pressure. So it's still, to your point, I'm not sensing a signal, and that's a little bit to Kai's point, of our ultimate, pension years, and perhaps Scott can elaborate on that. He's closer to them than I am. They're not telling me like, forego some of the return because I want things to be green and clean. I didn't get the clear message. It's an and. You need to make good returns, and now you need to be clean. So, I haven't got the message clearly laid out for me that I can dilute my returns in exchange for having things cleaner. So it's still we need to make the extra work, extra effort, perhaps in the longer term. So I like the comment, which is, we're going to have the demonstration in front, right behind me. We've had them a year ago, exit coal, exit oil, that's short-term pressure, and we're addressing it in the medium to longer term, which I think is better for the planet than just shoving off those bad assets to somebody who's going to be really comfortable exploiting them for the next 15 years. So yeah, that's a challenge really, and I don't have a good answer for you, Sarah.
Scott, you got a good answer or some ideas?
Yeah, listen, I'm too humble to say that I have the perfect answer, but you know, I think Emmanuel hits it on the head when he says it's not an either or proposition, that, you know, sometimes it's a, you know, invest and, you know, we see it all the time in thinking about even our transportation assets and maintenance of our toll roads. You know, when we do a good job staying on top and monitoring our, you know, bridges and tunnels and surface condition, we use less cement, you know, and less cement means less emissions. And so it's good for everybody. There's a number of trade-offs like that. You know, using, you know, drones to manage vegetation means that you can have more vegetation and you don't need to clear cut, you know, once every 5 years and then hope in the meantime it doesn't grow back fast and you have a forest fire. You know, so sometimes that technology allows you to do things smarter and better, and it benefits everybody. You know, the list goes on and on. But you know, the other thing is, you know, as an industry, I think we need to continually look at our social license to operate, and we need to do more than what is the minimum acceptable conditions, and start thinking about what and how we do right by the communities we operate in. Because another factor of our industry is that there's a lot of capital chasing few opportunities, and still the majority of infrastructure assets are owned by governments who have a hard time wrapping their minds around policies to privatize and hand assets over to private operators who we say, hand on heart, you know, we'll run them better and cheaper and all the rest. Please give them to us. You know, yes, we make profit, but we're better than government employees at doing that. But we got to put our money where our mouth is and actually do it better. And we can't have, you know, Genoa bridge collapses, and we can't have other things where it's proven that we were trying to make an extra buck for a couple of years at the risk of the long-term service that we have to provide to our communities. So, you know, the onus is on us to bring that value, and that's what we wake up every day trying to do at CPP.
Yeah, it's so true. And I think, Kyle, to your point on the bubble before, and bubbles ending badly with a taint, there are a couple of taints, you know, obviously a physical one or something like that. How do you think about, you know, maintaining or improving the collective reputation, the headline risk, not just, you know, for your own portfolio or your own organization, but for the infrastructure, a private infrastructure business much more broadly?
Well, these are really difficult questions. They're complicated questions, and they stretch into a whole range of areas. And I think, you know, one of the things that we're really trying to encourage and really looking for some help is understanding the depth of some of these issues. And that sometimes, you know, we've got a situation where the carbon footprint of one of our assets might expand really broadly, but the result of that is going to be a much lower carbon footprint for the entire country. We're going to shift some generation away from lousy generation to gas generation, and it's going to look like our numbers have gone up, but it's been a great result for the country. And so trying to explain that in a way that doesn't look like we're cheating or greenwashing requires an added level of patience and in some cases sophistication. And we're asking for that. And we, you know, we want to invest and not divest, but that sometimes results in numbers moving against you. And so we're going to work really hard on spending time with investors and explaining this is the broader picture, this is the timeline. And then, you know, we've been into situations around things like coal. Well, in some regions, coal mines are a lot of jobs, and there are a lot of jobs in places that might otherwise be disadvantaged or challenged. And so there needs to be a program around how you redeploy those assets. So it's not a simple question, and an added level of attention and sophistication and interest by all investors can help everyone solve the problem.
It's interesting because, you know, in investing, we always talk about a J curve, and you see that all the time, but you're almost talking about an upside down J curve in terms of the emissions themselves. And so how do you have the understanding that you got to go up to go down, and that you're actually on that path, that you're not just making that up. Fascinating. Well, maybe I'm watching our time. We don't have too much more, but I'd love to get the perspective from each of you on an opportunity that you're really excited about for the long term. So if you've got long-term money that you're going to invest in this world that is hopefully becomes more sustainable over time, can I go around the horn and get some ideas about what would be some interesting places that you think are piquing your interest right now? Carolyn, I may start with you. You talked about obsolescence, and I live in Boston, where if you walk around, you will see things built by whaling captains, because of course whaling oil was the technology of the day once upon the time, which is long gone. So we see that all around us. But maybe some ideas for exciting opportunities for you, Carolyn, and then I'll just go around my screen.
Yeah, so I've already talked about the water, and with what Kyle mentioned, the whole waste cycle. There's a lot of technology that helps with that waste cycle, even in terms of, we know power and the smart meters and things like that, but the new technologies focused on that sort of cradle to grave notion. There's no waste. Every waste stream becomes an input for another stream, and managing that is pretty exciting to us. That's an area that we're focused on.
That's really interesting. All right, Kyle, can I come to you?
Sure. Look, this has been a really interesting discussion. I love some of the terms. I've been sort of jotting down terms on the way through. But don't ever bet against human innovation is terrific, and I think that's spot on. And I think there's a lot of Nobel Peace Prizes in the back of some of the the potential innovation that we should see down the track. But I think our perspective is electrification is inevitable. It's starting now. It's going to take a reasonable amount of time, and people are going to trade electrons, and those might not be centralized or generated in a single place, but they're going to be generated in lots of places and traded around lots of different uses, and ultimately we think that's a way that there's going to be a real shift around emissions, and we're thinking about that quite a bit.
Oh, that's really interesting. We're going to have an electron market. Just yes, we'll think that's normal. Scott, how about you?
Yeah, at the risk of offending at least one or more of my global teams by picking a favorite as opposed to naming each of their pet projects, I'll say the one that I'm closest to, because I'm the chairman of a company called Transelec in Chile. And the thing I like most about that job is thinking about linking communities with industrial grade renewables, particularly from the north into the load center in Santiago. It's an incredibly challenging project that we're looking at right now to build high voltage direct current lines in collaboration and competition with some of the smartest transmission builders in the world. So we're looking forward to dealing with that in the next 6 months.
Sounds interesting. Emmanuel.
My favorite one is, I think, it's about kids, and it's, our asset lasts more than a generation or two sometimes, or three. And so it's alternative fuel or electric school buses. Frankly, this is because there's a lesson for the kids as well. And having, combustion engine school buses from 15 years ago go up and down my street, it's very frustrating. So that would be my pet project.
I like that it's both a lesson and an investment. That's a nice combination. All right, Sean, how about you?
I would just, similar to Scott and Kyle's points, I think the decentralization of power, the electrification of most of our fossil fuel vehicles and other generation, I think that will create massive opportunities. And I think the rollout of grid technologies that allow us to work in a more decentralized market and bringing renewables to market, long distance transmission. I think those are all spots that will be massive investment opportunities over the coming decade.
Well, the really interesting ideas, and thank you all for your insights and sharing. I, for one, am glad that you're thinking about these very complicated issues and all the implications, and it's an unbelievably complex market, and it's inherently long-term, right? The decisions you don't invest in something in infrastructure today and to change your mind tomorrow, like some of us in the public markets do. So I think it's critical to have that there. So and I like some of these things are going to stick with me. The betting against ingenuity and the denial cycle. I'm going to remember this. And the obsolescence, lots of these things. So thank you very much for this. The last thing that I will say is that we encourage organizations that are listening to this, that are interested in this idea of focusing capital on the long term, to follow up with us. Look at our website. We have a lot of research that is trying to help investors and companies think about how to do that long-term sustainable investing. And it's there for you to take and peruse as you see fit. So FCLTGlobal.org. And again, Carolyn, Kyle, Sean, Emmanuel, Scott, thank you so much for your time and your insights today. We really appreciate it.
It's great.
Thanks, Sarah.